OpenAI is pushing its billion-dollar launch to next year, and that single report just sank a major backer by 12%. Here's why the tech giants are selling off right now. Friday, June 26, 2026. Like and subscribe for daily market updates. Today's agenda: the big picture, market snapshot, Fed policy, global politics, commodities, crypto crisis, tech earnings. Up next, market snapshot. Good morning, it's Friday, and today the US stock market runs straight into its single highest volume event of the year. After the closing bell tonight, the Russell indexes reconstitute. That's the twice-a-year rebalance, where every fund tracking America's stocks is forced to buy the new additions and dump the deletions, all in a few frantic closing minutes. Last June, more than $200 billion changed hands in that one closing auction, and it could not land at a more charged moment, because the market's leadership is visibly changing hands from the giants that powered this whole rally to almost everything else. This mechanical shift isn't merely administrative. It represents a structural realignment of capital flows driven by index mandates rather than fundamental valuation changes. Historically, these reconstitutions have amplified unpredictable price swings precisely. When big-picture economic data suggests shifting momentum away from mega-cap technology toward broader sectors like industrials and small caps that were previously underweight in major indices. The mechanism works through passive fund algorithms, executing massive buy orders for newly included stocks, while simultaneously liquidating positions on excluded names, creating a temporary available cash in the market squeeze or surge, depending on the direction of inclusion lists. For investors holding diversified portfolios outside these specific index constituents, this event acts as a forced rotation lever that can distort short-term price discovery without altering long-term earnings power. Those relying solely on passive strategies must accept this artificial dislocation as an inherent cost of tracking benchmarks, while active managers might find fleeting arbitrage opportunities in the seconds surrounding market close, where supply and demand imbalances peak, before equilibrium restores itself by Monday morning opening bells. That brings us to Federal Reserve policy. First, the week in one line: brutal for big tech, quietly strong for everyone else. The Nasdaq, the tech-heavy index, is heading for one of its worst weeks of the year, down roughly 3 to 4% and falling for a fourth straight session. The S&P 500 closed Thursday almost perfectly flat at just under 7,360, off about 1.5% on the week. But look where the money actually went. The Dow climbed to within a whisker of its record high near $52,000, carried by industrials and healthcare. And the small-cap Russell 2000 pushed above 3,000 into fresh high territory, the only major gauge that gained on the week. That is the entire story in three numbers: tech down, value and small caps up. With rates staying high, let's see how global political tensions are affecting energy prices and oil markets today. The backdrop to all of this is a Federal Reserve that has turned genuinely in favor of higher rates under its new chair, Kevin Warsh. At last week's meeting, the Fed held its benchmark rate steady at 3.5 to 3.75%, but the message was unmistakable. In the dot plot, the chart of where each official privately sees rates going, 9 of 19 policymakers now pencil in at least one more increase. And the move they are debating is a hike, not a cut. Markets are now pricing roughly a 60% chance of a hike by the September meeting and around 80% by December. What is forcing that hand is inflation that simply will not cool. Which leads to commodities. The dominant global political narrative has fundamentally shifted from acute threat to strategic thaw, reshaping global risk premiums overnight. The United States and Iran have formally agreed to a structured roadmap aimed at securing a permanent peace agreement, with 60 days of intensive talks anchored by a high-profile signing ceremony in Switzerland. Simultaneously, Washington has issued a critical 6-month license permitting Iran to resume selling crude oil on world markets without immediate sanction violations. This diplomatic rate change is already triggering tangible market mechanics. Tankers are now navigating the Strait of Hormuz at their fastest pace since hostilities began. Historically, this choke point frequently bottlenecks supply. However, its current flow suggests a normalization that has not occurred in decades. As Saudi exports restart and regional tensions de-escalate, the war risk premium that artificially inflated energy prices throughout spring is rapidly draining from global commodity markets. For investors holding long-dated oil futures or stocks tied to petrochemicals, This represents an immediate recalibration of valuation models previously built on scarcity assumptions. The second-order effect extends beyond crude benchmarks. Insurance costs for maritime logistics are expected to drop sharply, while airlines and shipping firms can finally budget with certainty regarding route safety. Furthermore, the removal of supply fears should dampen inflationary pressures in transport-heavy sectors, offering a tailwind for manufacturers facing elevated input costs. This global political resolution effectively removes one of the few remaining structural challenges weighing on global growth forecasts this year. Here's crypto crisis. That hands us straight to commodities, where the theme is a broad bleed. Gold has cracked below $4,000 an ounce, its first time under that line since November, and is on track to lose more than 5% on the week, now sitting almost 20% under its January record. Its logic is simple. Gold pays no interest, so when the Fed is threatening hikes and the dollar is at a one-year high, the metal loses its shine fast. Silver got hit even harder, sliding below $60 for the first time since December, because unlike gold, it has no central bank buyers to cushion the fall. Finally, let's explore the earnings and deal news that triggered today's biggest moves in big tech stocks. Now, the crypto pulse has turned distinctly ugly as Bitcoin shatters below $60,000, tumbling nearly 3% today, while erasing about 11% of its value for the year. Ethereum absorbed a steeper blow, falling almost 6% to hover around $1,550. This sell-off is not merely emotional. It reflects a fundamental shift in capital allocation driven by big-picture economic pressure. As the US dollar strengthens and markets price in aggressive rate hikes, investors are rapidly rotating out of risk assets into a safe place to store wealth bonds that now offer tangible yields. Crypto, historically viewed as a non-yielding speculative alternative, becomes unattractive when government debt offers guaranteed returns without unpredictable price swings. This dynamic mirrors the 2013 crash following China's capital controls and bond market interventions, where available cash in the market dried up instantly upon policy shifts. The Fear and Greed Index has consequently collapsed to 8, signaling extreme panic rather than a temporary glitch. For investors, this environment demands caution. Chasing dips in high-beta assets like digital currencies during periods of rising rates often results in further losses as the opportunity cost of holding cash or bonds widens significantly. Until rate expectations stabilize and inflation cools sufficiently to weaken the dollar again, capital will likely remain locked in traditional fixed income, leaving crypto markets vulnerable to continued underperformance unless a unique technological trigger emerges to justify their zero-yield profile against competing asset classes offering superior risk-adjusted returns. Let's wrap up with what matters most for your portfolio as we head into the weekend. The market's defining twist today stems directly from big tech's own triumph. Memory chip giant Micron delivered a genuine blowout, reporting earnings of approximately $25 per share against expectations of just $21, while revenue more than quadrupled to exceed $41 billion. The stock leapt 16% on this news, signaling that the artificial intelligence arms race has finally hit its stride in hardware manufacturing. However, this very same memory boom now acts as a severe cost problem for everyone downstream in the value chain. As demand surges and supply remains constrained by complex fabrication bottlenecks, manufacturers are forced to pass these elevated input costs directly to consumers. Apple raised prices on its Macs and iPads earlier this week, explicitly blaming higher chip costs for the adjustment. This defensive pricing move was poorly received by investors who fear it will dampen holiday season demand or signal broader inflationary pressure within consumer electronics. Consequently, Apple's stock tumbled more than 6% in early trading, dragging down investor mood across the entire technology sector and leading the Nasdaq lower. Historically, this mirrors the 2018 cycle, when rising component costs forced major firms to trim margins rather than raise prices immediately, creating a painful lag before earnings could recover. The mechanism here is clear. Supply chain scarcity creates immediate profit for chip makers, but erodes profitability elsewhere until demand normalizes or new capacity comes online. For investors, this divergence suggests that, while pure-play semiconductor stocks may continue their rally, hardware integrators face an extended period of margin compression and pricing friction. The era of easy expansion into memory-intensive applications is real, yet it carries a hidden tax on the broader ecosystem that could weigh heavily on quarterly company outlook for months to come. So here is where we stand. This is a market quietly handing leadership from a handful of giant tech names to the broader, cheaper, smaller end of the tape. And tonight's Russell rebalance will pour fuel directly onto that move. The single biggest risk is that the AI engine, which powered this entire bull run, is sputtering. If the OpenAI delay marks a real turn in investor mood rather than a one-day scare, the selling in mega-cap tech has further to run. Thanks for watching Market Pulse Daily.